Everybody, it is Wednesday morning, at least on my side of the planet here, 9:30 a.m. in the Pacific Coast. Dr. K, you're there from London, I take it, again.
Yes, at the time.
Okay. Uh, Anyways, I hope everyone can hear me okay. Everybody just shoot me a yes there real quick. All right, that's what we'd like to see. No problems. Anyways, it's been kind of an interesting couple of weeks, since we went on to the sell signal on the NASDAQ, running into resistance here. We've had a rally back up. And I would say from my experience, if you're trying to play the short side, this is a type of thing that will drive you nuts, but you do have to be persistent, I think. And we're obviously, we haven't been stopped out because you wanted to go 1% past the 2612 fail-safe, right? Right, Dr. K? That's how you were working it? The model was working it?
Well, that's on the basis of the NASDAQ composite. But see, when the model sees a divergence, like we've seen pronounced divergence between small cap Russell 2000 and the large cap NASDAQ 100, which has also been pushed
Right.
higher by the action in Apple, the model then will switch to the lagging index. In other words, the Russell 2000 has to catch up. It has to essentially move above the prior high it set 3 days ago. Now, if it does that, then the model will move to a cash position, if not a buy signal. But it'll certainly move out of its sell signal. Until it does that, the model is most likely going to sit on the sell signal, as there's much sign that this market needs to retest prior lows.
Yeah, I mean, there are a few leaders out there, and it's possible to make money trading them. A lot of these have had pocket pivots, but the moves often don't last very long. But the essence of what we're seeing right now is we're looking at the NASDAQ. You rally back up into this area of resistance, and it really hasn't been able to get through there. Now, is it going to? We'll find out, but it does seem like you're at a logical place to fail. And as far as I'm concerned, this market, for the most part, is being led by big cap NASDAQ stocks, and we've seen those. Apple's been doing well, Amazon has been doing well. Priceline tried to break out yesterday and reverse. Baidu's starting to break down, however, but for the most part, you're seeing a number of the bigger NASDAQ names acting okay. So it's been driving this narrow rally, and so it could continue to go higher on an index basis. But yeah, our strategy essentially was to shift. And that was out of the SQQQ as you were coming up into here, and then into the TZA, which keys on the Russell 2000 index, because that's much weaker. And this is definitely in a reverse bearish pennant formation in my view. And you could even say that the NASDAQ is still in something like that. A lot of people want to make a lot out of this uptrend. I think it's still unresolved to some extent. If we saw better leadership, broader leadership, and breadth start to improve, then that might be another thing. And of course, that could always happen. Remember, the market is always about possibilities and not absolutes. So we have to operate on the basis of the best information that we have. So right now we know that this is a narrow rally into logical area resistance. Generally, it'll take you a little past. That's why Dr. K has the 1% built into the fail-safe, above the fail-safe number of 2612 built into the model. In order to prevent this sort of thing. Doesn't mean that we couldn't get stopped out and then the whole thing would roll over. That could happen too, but then I would imagine we would get a sell signal to come back in. And I think you just have to go with the signal. So that's all we've been trying to do. We haven't been trying to outthink this market. I know we've had some emails from people out there asking us to, can you give us your views on what's going on in the market? And a lot of times the market's just doing what the market's doing, and if you get caught up in what's happening on a moment-by-moment basis, I think you can get thrown off, and a lot of times what we find ourselves doing is like, just stop looking. My trader Bill Griffith will tell you during the day. Sometimes I'll just tell him, well, I'm going to go outside for a little while and just stop watching things, and I think that's a lot smarter. You take your positions at your short sell or your buy points, whatever you're using, and you have your stops or you have your profit objectives, or you have a set of conditions that would tell you, like, maybe I don't want to be so long something, and maybe I'll take the profit. So, you've got to operate on what suits you. and just stick to your objectives and your stops. And I think that's really the best way to approach it. And Dr. K and I were talking about this over the weekend, and he's studied, how the market's moved and how stocks have moved, and there's been a lot of volatility all year long. But with the leading stocks, it's basically been a matter of taking a position and then trying to sit. So I don't know if any of you can hear the dog a couple of houses over, but I guess he confirms what I'm saying there. So he's probably giving us his own market commentary. In any case, so that's really how you have to work it. Take your positions and see where you're going. Go ahead, Dr. K.
Last bounce that we've had that started about a week and a half ago, I do see action on the part of institutions. In other words, big money flowing into the leading stocks that we track, like Apple and Amazon and Priceline. So in other words, a lot of these guys, they got to be invested. They can't be out of the markets, and they've got to hit their bogeys. They've got to keep up with the market averages. So when the NASDAQ bounces like we've seen it do in the last week and a half, these guys got to pile back in to the Apples and the Amazons of the market universe. And the second point is that Europe's had a lot of trouble, and there is, the saying that the U.S. is the tallest standing midget in the room, and these leading stocks are the benefactors of that aspect of the way the world is at right now, with the U.S. being taller than others, although it's not very tall in my book. There's not too many places that are tall except perhaps some of the creditor nations.
Well, tallest midget.
Yeah. So at any rate, the model is going to watch the Russell 2000 to see what it does. It's also looking at the XLF, which is the financial index, and that's doing very badly as well. So usually you don't get a concerted market rally just led by a few scant names. And the other aspect also is if, say, Bernanke today announces something that the market loves to hear, such as, okay, we're gonna get going with this QE3, we're going to see it in the price volume action of the market. So that would take the model potentially out of its sell signal and straight into a buy signal, but we have to see that on the tape first before the model's going to make any sort of changes.
So, we're taking the market action for what it is, and we're operating on that basis, not trying to lean one way or another, just going with the signal, okay, and not trying to outguess things. And I think a lot of people want to try and outguess what the market's going to do on the basis of today's Fed announcement, which many are expecting this Operation Twist. It's something that they tried in the 60s, Kennedy's administration, or during Kennedy's administration, they tried this. And essentially what they do is they sell off their short-term notes and bonds, rather bills, and buy the 10-year. The idea there is by buying up the supply of 10-year bonds out there in the marketplace, they drive down yields on the 10-year. And since a lot of consumer rates, car loans, home loans, etc., are tied to the 10-year rate, the idea is that it'll lower rates and people can borrow. My view is that that's sort of a ludicrous concept. In this economic environment, people need jobs. They don't need the ability to borrow more money or lower interest rates. I don't think people are looking to borrow money so much as they're looking to make money. So I think, again, it's not addressing the real problem, which is the structural deficit in employment in jobs out there, and they're not addressing that. And unless that occurs, I don't think you're going to have any economic growth. I don't think it solves any of the problems, particularly people's debt problems with respect to consumer debt and mortgage debt. So I don't see what they're going to do today that's going to drive the market higher. And we're in a position where the market could fail. So that seems like a potential scenario. Now, keep in mind, this is just one potential scenario, but it seems likely. And it seems likely given to where the crowd has been swaying. A lot of people are getting more bullish. And they think the rally off the lows of August has been constructive. And, it's been higher highs and higher lows. But there's a lot of volatility. And in the midst of all this, we also see leading stocks, such as Netflix, which we should probably qualify as being a former leading stock, blowing apart here. And I think that's telling you something about the underlying tone to the market. So we'll see how things go after the Fed comes out with their announcement. But we don't put a lot of stock in it, but we'll just see what the market does and react to that. In the meantime, we got you into this ride here, A lot of times you see a breakdown through a neckline like that on a gap down. If you can establish an intraday high similar to a gap up, a viable gap up, you can come in and take a position and use the high of the day as a short stop, a quick stop. And I'm actually surprised at how much velocity this thing has had to the downside. I was looking for 20%, so I covered actually in the 140s and thought I was doing real well on a 3-day break. Usually you'll get 3 days down max, and then they'll try and bounce, but this thing's coming down some more. Now I think you're coming into an area where you are seeing yesterday heavy volume capitulation selling, and it's trying to hold. So I would be logical for it to try to bounce, and I would be watching for that. Netflix is done, and I think if you're looking at a long-term basis, here's a weekly chart. You can see the big price run, the left shoulder here, here's the head, and you do have the big break in volume defines the right side of the head. It's not one of those split them wide open type of patterns like Crocs was in 2007 or Finisar was this year, for example, where you have this very obvious break off the peak, and it gives you, here's your left shoulder, your head, your right shoulder, and now notice on this one you're rallying right into resistance. It's possible this could roll over again. I'm keeping an eye on this actually. But it's a little bit shallower, and these are actually typical of the biggest of the big leaders. They'll be a little bit slower, less sharp breaks because there are always a lot of people interested in buying them, so they do find support at levels. So these patterns will tend to be a little more subtle than your smaller, hotter stocks like the Crocs and Finisar and those similar ones like that. I remember C-Cube Microsystems in late 1995 topped in a head and shoulders pattern. You guys can check that out in the book, How to Make Money Selling Stocks Short, that I wrote with Bill O'Neill back in 2004. Still being sold on Amazon. But you know, when you do see this breakout to the downside, and it's a gap move on heavy volume, that thing's probably going lower. So you can play it, and that's why we put that out there for those of you bold enough to take it. Now, this morning we put out Cena, which the way I see this is you have a climax top here. So this is basically your climactic top, and sometimes these things take a long time. You can go back and look at Qualcomm, which I've compared to LVS too, because Las Vegas Sands was also a climax top way back in here, and it's still trying to noodle its way around. Let's see if I can shrink this a little bit. Whoop, wrong way. You can see this thing is still trying to work its way around, and I would be surprised if we see it fail from here someday, but so far I don't have any shorting signals. But it's an example of a climax top followed by a long period of consolidating that move. And I suppose it could come out again in a new base, but it seems very jagged and very volatile. So I would think that it's probably more like Cena. I'm sorry, that Cena is more like Qualcomm, and it's probably going to break down sooner because you are seeing huge volume yesterday. You rallied up into the 200-day moving average. We sent out the alert. It's trading about 96 or so. We think 98.67 would be your upside stop. You give a little more room for those who can give their positions even more room. You could give it up to the 50-day. But this thing looks done to me for the most part, and we're starting to turn red on the stock, down 8 cents. I am short this thing. So just so you guys know, when we put out the alerts for anything, we're no longer going to disclose positions. There's a disclaimer at the bottom of every email we send, and it's quite clear that any of us in our firms or related to our firms or affiliated with our firms could have a position in anything we're talking about. But what I find what happens is if we just disclose that we have a position, then everybody wants to key off of what we're doing. And I got to tell you, when I'm working something on the short side, I may short it and cover it and short it and cover it several times before I actually hit it and make some money. And a lot of times that can happen in the same day. So what I'm doing, what Dr. K is doing, what Bill Griffith's doing, what anybody else who works with us is doing with their own positions is particular to how they trade, okay? So I think it's unhealthy when people start to get into this position of wanting to email us, well, what are you doing with your position? What have you done with your position? How have you handled your position? It's not relevant in real time. And so I think you just kind of go with what you see and how you want to handle things. So on Cena, you can put the position out here, 36 level, even 35 level. Your stop could be 98.67 for a quick one. And I think this thing's going to break down because you have the climax top, and you can see that it's breaking down. You can also see on the weekly chart it's all pretty ugly in here. You have some weak volume here. It's stalling out these 3 weeks a bit, and now we're rolling over with volume picking up. So the chances of this thing heading lower seem pretty good to me. So if you are short this right now, you can figure out how you want to handle it. What's your profit objective? Well, I think you can get down to this low here, which is 82 bucks, or you can get down to this low here, which is 77.33. And it may undercut and then try and rally, but that's not 100% guaranteed. Things can just blow to pieces, and I would say one stock like that, looks like a Netflix here, I thought it would undercut this low here and maybe try and rally a little bit back up into one of the moving averages, but no dice at all. It just keeps going straight down. So in this case, that can fake you out, and you can always come back and short again if it doesn't undercut and rally. But that would be a logical spot on Cena, but it could, like Netflix, just blow through everything. So here, here, and here, these are your lows in the pattern that it can undercut. For all we know, it blows right through them. For all we know, it stops right here, turns around, and goes higher. But I don't think that's the highest probability. Right now, you got to play it as it lies, to steal a golfing term.
And Soho's having a lot of trouble as well.
Soho's the weakest one in the group, and that's also, you see how this is the head and shoulders. Here's your left shoulder, here's your head, here's your right shoulder. So this is breaking down, but it's not through the neckline quite yet. So there's a little bit difference here. That's why I think Cena probably has more juice to the downside, but I think all of these are going lower.
Yeah,
but you're heading for the neckline.
As well is having a lot of trouble. NetEase at their last earnings gap down right into the 200-day. So it's hit the 200-day now for the fourth time, and there's a lot of selling pressure coming in on this one.
Yeah, and it's pretty weak too, and it's breaking the 200-day. But the whole group is weak right now, which tells me go with the weakest one. So the way I look at it is, if you look at these, let's fatten it up again. Cena's move yesterday was the weakest of all the Chinese internets, I thought, and so to me this is death, and this thing's probably done. So I'm very comfortable having a short position and using the 200-day as my quick stop. At this point, though, on an intraday basis, I might consider using a tighter stop. So, so that's where we are with those. We're not putting out a lot of short positions because the bottom line is in any bear market, there are going to be like 4 or 5 of the best chart patterns to jump on. And you'll notice when we start to get profuse, for lack of a better word, on the number of stocks that we're talking about, because we went out the other day and we saw all these, Deckers, any day now. There we go. Deckers at the 50-day. It sure looks shaky, but look, it's gone right past. It might be shortable now, but I'm not playing that right now. It's not in position. Same thing here. These all went through and they've held up. This one's gone through a little bit. Limited was another one we were looking at. Under Armour we were looking at. And these have all gone past, so I'm not really interested in these. And when you start spewing a bunch of short ideas out, what happens is there's too many, and you really have to try and limit yourself to the ones that you think are the very best setups. And in this case, the Netflix is beautiful last Thursday. And I think today I like what's going on with the CNET. So you can extrapolate it out to the other internets if you want, the Chinese internets, and short them. And here's CNET, or NetEase rather, trying to rally back up into the 200-day moving average, and maybe it breaks down. See, but in my book, when I look at them, I'll look at Sohu, and yeah, that's weak, but it's down already, so I don't want to short that here. I look at Baidu, and I think that's probably shortable here, but it is the biggest one, and I do have a position short in this right now, but I'm just kind of testing it out. It's not huge. But I think that this is probably going to go as well, and if you see Baidu go, you definitely know NetEase, Sina, and Sohu are going. So, but Sina looks pretty weak, and it was a nice position there. I like all this selling here, and there's no real news to account for it. There were some changes. They're talking about allowing Chinese companies to list out of China. The Chinese government's babbling something about that. I don't really pay too much attention to it. I just watch what the stocks are doing. Okay, so that's where we're at on the short side. Some other things I've been watching, RACS is kind of weak here, but it's kind of inconclusive. You got the 50-day crossing below the 200-day. Usually, if they're going to break, you'll see that occur. And you can go back and look at a lot of examples of short sales where the 50-day crosses the 200-day to the downside. That's a black cross or a death cross or whatever you want to call it. First time I ever heard anybody talk about that was an old-timer at the Merrill Lynch office in Beverly Hills when I was a rookie broker, and they called it a black cross, and I've been calling it that ever since. So, all right, let's go through some names here. Would have been nice if more of you had emailed us your questions because it's kind of hard to go through this. One of the things that I've been telling GoToWebinars to make their IM window, instant messaging window, from you guys bigger because it's really hard to go through these questions. It allows me to see 2 lines. Let's see. Okay. How about higher highs? We talked about the NASDAQ. We're not buying it. Okay, let's start at the beginning. LinkedIn. It's trying to build a base, but I'm not a buyer. Open. Okay, we talked about this as a short also. It's working so far. And it's slowly breaking down. My guess is it's going to continue to break down. I would use a 10-day moving average now at 53.90 as a trailing stop. If this thing's going to accelerate to the downside, which is what you really need to see it do here, it's going to stay below the 10-day. And a lot of times these things will start to break to the downside when they get going. They stay below the 10 or the 20-day. You can see that this has roughly found resistance on rallies above the 20-day here, but that's while it was in this sort of descending flag formation or whatever you want to call it. And it's fallen now out of this formation if you look at it like this. This is another one we talked about. We gave it to you guys around 57, 58. So you're coming out of this sort of channel, this downtrending channel, now you're breaking out through the lows of it. So it doesn't, Open is an interesting stock because I haven't shorted them, not now. I've moved to things like Cena and some of the others like Netflix I've been playing because they're just getting a lot more velocity to the downside. So it's a matter of where you're going to put your money. You're trying to get the most bang out of your bucks, and Netflix has given us a lot of bang. Cena so far today has given us some decent bang, and we'll see how the rest of them go. But you know, that's still in play, and it's still going lower. But I would use a 10-day as my trailing stop. Okay. Let's see here. If you were in cash and wanted to follow the MDM, would you wait till at least after the Fed speaks or even before? Oh, here's one for you, Dr. K. Did you catch that? If you were in cash and wanted to follow the MDM, would you wait till at least after the Fed speaks or even the last hour before getting in line with the model? Thank you.
Well, when the Fed speaks, the market tends to be fairly volatile, and I would say that, you know, when it comes to the model, look to see where the model issued its signal. In other words, where was the NASDAQ and the Russell 2000, the major indices trading, and then if you, wherever the NASDAQ's trading today, right now it's at 25.94, and the Russell 2000, you know, it's trading. IWM is at 68.54. Look at how far away you are from where the NASDAQ, where the model issued its signal originally. So in other words, if we're say 1% below where the model issued its signal, in other words, you're 1% in the money had you acted on the signal on that day at the time that the MDM came out. Know that you have 1% greater risk in taking the trade, simply because the model doesn't care where you get in or get out. All the model cares about is guarding its failsafe. Its failsafe is based to an extent on where it gets into the market, on the sell side or the buy side. So in other words, if we're 1% in the money right now and you want to take the trade now, that's 1% added risk to your trade. So we have a lot of questions. Getting in, should we get in late? I just joined. You know, the NASDAQ is trending downward, and the sell signal's been going on for a week. Is it too late to get in? It's probably too late to get in if that percentage is beyond your risk tolerance level, whatever that is. For a lot of people, it's going to be 7 to 8% on a 1 times ETF. For other people, it's going to be 12% on a 3 times ETF. So it all depends on the individual.
Okay, thanks, Dr. K. Go through some other names here. Let's look at UA, Under Armour. This is another one of these retailers. Looked like it could have been shortable here, and it just went right past. So it's rolling over now. Could you come back and short it? I guess, but there are other targets that are really in a better position. My guess is it will eventually break down, but wait till that happens. If I got stopped down here, I think I tried this one. One of those I did. I forget which one. I might have been pinging them all, Limited, Nordstrom's, Under Armour, Deckers, all of those, and I just got blown out of all of them on the upside because they didn't hold. But I wouldn't. I would avoid that for now. Now MCP, I actually shorted this one yesterday myself, and this is something that I've noticed with recent examples where you're breaking down. You can see if we look at MCP, it's kind of a, I guess you'd call this a kind of a pod-like, a punch bowl of death-like cup formation, and then it breaks down and blows apart here. And you notice, see how this break occurs with the 10-week or the 50-day crossing below the 200-day moving average? I think this stock's done. And when it gapped down yesterday, I went short the stock. I thought it was kind of risky. I thought it could turn on me, and I was actually very surprised. I think I got in right around 49.50 or so, and right at the opening on the gap down. But what I've noticed is when stocks are weak and they gap down, you can usually hit the gap down. Like potash was a good one the other day. I hit that. And see how that gaps down here, and now you come after it and it really gets some velocity to the downside. So what I'm noticing in this market is when they do break support, either moving average or the neckline of a Head and Shoulders like we saw with Netflix, or even with Molycorp, breaking down, and you could say here's like an uptrend line you could draw across these lows here, and when it breaks that, that's a breakout to the downside. Now I'd be looking for any rally up in the 45 to short this thing, but it isn't really doing it. It could just continue lower because of the velocity of this gap and the amount of volume. So it's possible this is even shortable here using, say, 45 as a short stop, which is about 5% away. I mean, that's possible. But it's a volatile stock, but I do think this thing is headed lower. And now we know why MCP has always had such a low PE. One thing we pointed out about this when we talked about it in the past is that it's trading at 5 or 6 or 7 times forward earnings. Are we there? Everybody there? Hello?
Yeah.
Okay, I'm showing connection lost. Is everybody there? Everybody tell me yes or no if you can hear me. Okay, I think we had a temporary outage on GoToWebinar because we didn't lose internet. Everybody there? Somebody give me a yes. Okay. Well, let's see here. Okay, good. Just want to make sure everybody's coming up. That was kind of strange, but that's one of the glitches sometimes we get with GoToWebinar. Their network will shut down. It wasn't on our end because we didn't lose connection between us. But in any case, so this is breaking down. I think it's heading a lot lower. And like I said, you could short it using maybe the 45 area as your stop. So this is still in play, and I think it's going a lot lower. So let's get through some other names here. ACOM is potentially one, I think. You know, that's breaking down. Look for a breakout to the downside. This is probably going lower. I think you could short this using today's high as a stop, as a quick stop. Somebody's asking about Flowserve, FLS. I mean, you notice there's a lot of stocks like this. I noticed CAT also has a similar sort of look, and a lot of these look like they want to go lower. So I think probably you could be short these. You know, then they look like they're going to break out to the downside, and that's what's going on here. And I do see this in a lot of patterns, which leads me to believe that the market's going lower. So
yeah, the price of oil.
Same thing. It's breaking down. It's starting to break out down. Yeah, Dr. K.
Yeah, the price of oil and the CRB index, which tracks the basket of commodity prices, they've been both showing a lot of weakness, and they've both undercut their 200-day moving averages. And you know, it's an indication that demand on commodities is weak, and that's telegraphing that we could be headed toward a global recession.
Yeah. Alumina, the same thing. You see how this is falling off? They're all falling off the ledge here. And this is what I call these. A lot of times something breaks and then it does this ledging and then boom, you break to the downside. I don't think this is good for the market. And you're starting to see this. This is the underlying tone to the market, which is pretty pretty weak. Oh, I see what happened now with the GoToWebinar, Dr. K. We scheduled for 9:30 to 10 o'clock, and apparently it shuts you down when you set a time limit, and then you have to re-log on to get it going. So make a note of that, everybody. Let's see, some other names. The ags, like I was showing you potash, you know, it's the same thing. You have they're all breaking down. And so this is like the Chinese internet. Everything's breaking down, though. If you look underneath the surface of the market, everything is breaking down, and it looks pretty ugly. So, you know, Monsanto, trying to hang in there. But, yeah, that's kind of what the market looks. Everything looks ugly. We're going to focus on the stocks that we like short. So right now there's only 3 out there. Open Table, Netflix, which I think you should be covering and taking some profits in here, maybe half, and then looking to get short again on a rally. Cena's working pretty well today. It looks good, and it's in position. Meanwhile, we've been teasing you without making any mention of silver and gold, and of course everybody's wondering about that. But our view is and continues to be that these are just in consolidations. You know, it's trying to violate, you close here, but you don't go lower, you rally above the 50-day. Then you close here, but you never go below this low. So it hasn't violated the 50-day moving average on the SLV. Silver hasn't. So there's nothing really wrong here. And I think you may have to give it a little more room. If you look at a weekly chart, these actually look constructive. Last week, volume picked up a little bit, and you close off the lows, and we'll see how we end up closing this week. But I think you have to remain bullish on these. And you know, when people sit there and tell you, oh, gold and silver, they're in a bubble, because they don't produce anything, that you don't have any earnings, you don't earn interest on it like you would with the bond, you don't have earnings and dividends like you would with the stock. And that's a bunch of BS. Because what's driving the price of gold and silver are simply their roles as alternative currencies. And so dollars, euros, yen, renminbi, escudo, whatever you want, whatever currency. The currency itself doesn't produce anything. It's just a store of wealth or a measure of exchange. Okay, that's what they're. And so what's happening is when you have people printing euros and dollars and whatever else they want to print, you're increasing the supply of those relative to the supply of other accepted currencies such as gold and silver, and so that drives the price of them in nominal terms up. And that's what that's all about. It's not about buying an asset that produces earnings or produces a product, or buy an oil stock and it produces oil. But the stock itself doesn't. So I would remind people also that common stocks are also pieces of paper. And if a company that you own common stock in goes bankrupt, what do you own? Nothing. Because the bondholders will be paid off first. Common stockholders, you'll probably be taken to zero, and you're going to get nothing. But you'll still have your piece of paper. So it's all relative. It's all perception. So what drives gold and silver is not their earnings power, their ability to earn interest, or any of that. It's all about their relative nominal value as accepted forms of currency versus fiat currencies, and so that's what's driving. That's the fundamental basis for it. And so I wouldn't get caught up in what other people want to get into with, it doesn't produce anything. So it's all paper in the end. Like they say, you can't take it with you. So let's see.
Yeah, I want to make a comment on position sizing, and in terms of how people might handle the gold and silver ETFs. And we bought AGQ and DGP twice now. So in other words, we don't have, it doesn't take up very much of our portfolio. We plan to pyramid these like we did before, and did very well by using that tactic, because when these things get going, they tend to have a nice uptrend. Right now they're in a basing pattern. We bought it twice. It's trading close to where we bought it in both cases. And we're just sitting, and we have no problem sitting on a small position psychologically, because first of all, if the base wants to continue for another 3 months, that's all right. I don't have a problem with that, just simply because it's not taking up much of our portfolio. If for some reason silver and gold want to go lower, that's still okay. But odds are that they're going to form a base of some duration, and they're going to break out, at which time we're going to add to our position. In fact, we're probably going to double our position, and then we're going to continue to pyramid it as it goes higher. And that's what we did with AGQ earlier this year.
Right. That's why we're up nicely in a year when most people are not. So gold, same thing. You can see it's consolidating. A lot of people see a double top, and I love somebody, I was reading somewhere that somebody called this a Adam and Eve double top, where you have Adam, he's very sharp and pointy. Gosh, I wonder what that's referring to. And then Eve is a little more rounder and softer looking. You know, I don't know, if GLD had just blown to the downside from here, I'd say this is pretty not Eve-like, but okay. But the bottom line is that gold and silver remain in long-term uptrends. So I don't think this is a double top at all. I think what you had is it was actually ready to break out and go higher until the CME raised margin requirements, and that put the skids on it for a little while, put the brakes on it rather. And that's all that's going on here. Otherwise, I think these are going higher. And if you look at the weekly chart on the GLD, you know, pulling back, you would call this a 3-week base, I think. And you notice how you close up well up off the lows 3 weeks ago, last week, and now this week you're coming up off the lows so far. It's only Wednesday, but you're holding the 10-week moving average. In the GLD, what just happened there? I hit the 5-minute. It's holding above the 50-day moving average. I won't worry too much about the 20-day. You know, it held it from here, but GLD gold tends to hold the 50-day. So we're fine. There's no real nothing to worry about. So, and then you know, people want to start to outthink of it. What are the flight to safety issues? Like, blow it all off. Just watch the price volume action. There's nothing wrong with it. It's fine. And if you want to start thinking about it too much, I think you're just going to get yourself scared out of your position. But as long as there are people out there in the media telling you that gold is in a bubble or now that the top is in and all this, I don't think so. I think it's probably holding up. So we'll be here until we see this break the 50-day, and at this point it would have to go below the prior low right around, I think it was 1703 on gold bullion. So that's where we are with that. And I think that pretty much covers all we had to say. We don't want to make these too long. I will answer one question here. I think it's a good question. Do you see more headwinds with increased margin requirements in gold or silver? I actually think raising the margin requirements is constructive for the long-term trends of the precious metals. And the reason is that commodities typically, I think, they're 10%, 20% margin requirements. They're a lot less than stocks, which are 50%. And what that does is when it starts trending very sharply, it brings in a lot of hot money, so short-term money. And I think by raising the margin requirements, hot money are weaker hands. They're more likely to unload when things get hot to the upside. And I think by raising margin requirements, you squeeze out some of the hot money and stabilize it a little bit. And you can see that after the raised margin rates, you are trying to stabilize here. But I think that's better for gold and silver over the long term because I do believe they are gaining more of a role, and I don't believe that they've gotten anywhere close to where they can get to. But they've been playing a broader role within the mindset of investors regarding the need to be allocated in gold and silver as alternative currency. So, you know, as the mainstream moves into gold and silver, it's healthier, I think, constructive for the metals if they are stable, and by wringing out hot money by raising margin requirements, I think that's constructive in the longer term, intermediate to longer term, whereas in the short term it's going to cause a sell-off right off the bat because you're going to immediately squeeze out the hottest of the hot money. So don't really see as a long-term problem. So somebody, quick question on Apple before we wrap it up. Apple broke out and it's acting okay. It looks a little bit obvious. To tell you the honest truth right now, I was playing this long side going through 400 right here. I'm testing a little short position because I just want to see how it feels. Because my thinking is this: if Apple weakens and fails on this breakout, that's going to have broader implications for the market. In the short term, I think money's being driven into it. But when you break out and you're 3 days up from the breakout, I'll test it out, see if it's going to be a late-stage break. And for me, I know it may sound irrational, but it's just the idea of having a skin in the game and having a visceral feel for what the stock is doing. So, and I think I'm almost certain that if Apple breaks down, the market will really get hit. So, and I think these breakouts are a little bit obvious, and they're a lot of narrow leadership right now. Or actually, that's kind of an oxymoron there, but the leadership is very narrow here. But you're seeing a lot of these big stocks. What I really mean to say, acting well. So, anyways, that's all we've got. Dr. K, anything to add?
I think
Final
we're
words of
good.
wisdom?
Just watch for the Fed announcement, but expect volatility and expect also quite a bit of unpredictable volatility, which is the nature of volatility. Therefore, I think that it's a very tough game to try to position yourself as the Fed announcement is coming out and watching the market trade, because you can get faked out very easily by the market all of a sudden rallying on you, making you think, well, maybe it's a good announcement, and then literally 15 minutes later, the market is now in a downtrend. I think we've all seen that kind of market action. So it's better to have a broader view of how to strategize and manage your stocks and your ETFs.
Good point, Dr. K. So like we were saying, just take your buy points, your sell points, and your stops and whatnot, and just operate on that basis, because you can just get swayed by a lot of the noise. So that's all today, you guys. Good luck today. We'll see how things go after the Fed meeting, and if there's anything really significant, of course, we will conduct a webinar. We do think, however, that what we don't say is sometimes more important than what we do say, and there are times to relax and not think so much, and I don't think you need somebody chattering at you all the time to make you relax. I think if you need that, then maybe Valium is what you need, and you probably shouldn't be trading. But when we're quiet, there's a reason why, and that's because we don't think there's a lot to say, and we're just going to stay the course without thinking too much about it until we're stopped out. Okay? On that note, you guys, good luck, and we'll talk to you later.
So long, everybody.